Thank you very much, and it's so great to see a full room here today, and good morning, everyone. We have a fantastic panel here this morning. It's really exciting. As you heard, we're going to be discussing efficient capital structures for real estate investment in East Africa. Now, what are efficient capital structures? Well, I think ultimately we're talking about the tools for our toolbox that investors use for leverage to enhance their return on investment, and that we as a sector really use to attract capital. Now, we all know we live in a highly globalized world. You can sit here today and while we're talking, invest into a REIT in Tokyo or buy a branded residence in the Gold Coast. So in Africa, we have to be competitive at a global level, and that's really the crux of what we're talking about today. We all know that we've undergone a period of huge turbulence and uncertainty. Following the outbreak of COVID-19, we saw a concentration of investment into certain asset classes like logistics and multifamily, and a retreat from others like that were difficult to underwrite during a sort of lockdown environment. Now, real estate globally was pretty resilient. We saw quantitative easing and stimulus fuel exuberant stock markets, and equities soared, and a lot of that the real estate sector benefited from. And then at last, a vaccine, and the world slowly began to turn back to normal. But we were left with a hangover in the form of inflation, right? And I think that's been the dominant prevailing trend, and the ECB and Fed have really, the hawkish approach has really loomed over global real estate markets for the last 18 months and been far more fundamental almost than the original lockdowns, albeit one ultimately led to the other. Now, inflation across the world, as we know, has been driven by multiple factors, some common, some unique. Global shipping prices soared during COVID. We saw commodity prices soar once Russia's invasion of Ukraine. The prolonged lockdown in China has really impaired global manufacturing and retail supply chains. In the US, the lingering impact of stimulus and Trump checks, which really drove up domestic demand and found its way into higher pricing. And all this really sort of created this inflationary environment that we find. And although many of these started easing and tapering in Q4 last year, as a real estate hasn't necessarily responded that quickly because we've been met with a whole new set of challenges, right? Banking crisis, tech layoffs, and what we've seen in the US. So it's really been tough, and you can see that in a Q1 2023, global investment volumes are down 56% versus 2022. So you still have a lot of capital waiting on the sidelines, but just waiting for these conditions to improve. And a lot of it stems from what our discussion's about today, the cost of capital. So what does this mean for Africa? Well, a lot actually. The pandemic saw governments needing to increase spending on social programs, and this came after a period of high sovereign debt accumulation and a love affair for Euro bonds, which we all know about, and this really has found its way into heightened pressure on currencies and mounting concerns around the ability to service sovereign debt, and we heard a little bit about that more in the previous discussion. So ladies and gentlemen, it's not pretty out there, to be honest, but there is light on the horizon. Inflation will ease in the second part of this year, rates will taper, easing pressure on sovereign debt repayments, and ultimately bringing down the cost of capital for real estate. So the discussion today comes at a really important time because we have regionally the duality of fundamentally very good growth. It's a good growth story. We're seeing a lot of corporate occupiers coming into the market, taking that bet on the long-term sort of foundations that Africa brings. But we cannot remove ourselves from what is happening in the global economy and just how, it impacts us far more profusely locally. So we cannot impact the direction that our economies go and fiscal and monetary policy. That's not what we're here to do. We have to equip our real estate sector with the right tools for every occasion in that cycle. So without further ado, it gives me great pleasure to introduce my colleagues on the panel here this morning. So we got Stephen Maloa, partner, corporate and commercial at Triple O Claw Advocates. Godfrey Tapela, Senior Investment Officer at IFC, Peter Mayavi, Managing Director at IHS Kenya, Ngacha Kirungui, Managing Director at Spearhead Africa, and Simon Chamali, Consultant Mezzanine Finance at ABSA Group. So, without further ado, Peter, I'll start with you. What are the challenges that you're seeing around the current cost of capital? And this has clearly been a global challenge, but how has Africa fared in this regard?
Thank you, Wayne. I think, let me start by introducing IHS. We are a Pan-African PE fund. We have raised globally over $770 million. For Kenya, we've raised so far about $85 million, which we are going to deploy into affordable housing. We're also the foremost practitioners of Edge, IFC Edge, and that's why Tapela is always sitting on my right-hand side wherever we go. We have over 9,000 units for Edge in Africa. For the Kenya Fund, all the houses that we are going to deploy will be IFC Edge certified. I think we aim to raise close to $130 million for Kenya. We are going to close the fund in December of this year. We are actually right now advanced talks with a major DFI to close an additional funding, which will bring our funding to about $130 million. So the challenges we see, of course, there's the usual, buzzwords, which we have to mention at every conference. The usual, the FX movement, taxation, macros. If I don't mention that, then, Somaya won't invite me again. So those are the usual buzzwords. But let me drill down to what is, what, for instance, us as IHS have seen as, the current, challenges and the cost of capital. The way we are set up, we raise capital in terms of only equity. We can't raise debt. And when you raise equity, you have to, you are pitted against, fund managers pit you against things like, government bonds and government paper and things like that, which are considered a bit more, risk-free than equity. And you find that that's another a big challenge. Another thing about debt and also from the formal market is whenever you see a term sheet from Zara, where is Zara? The first line says you need to deposit your grandmother. They're very they're very difficult terms, in the formal market to raise. And imagine now you want to raise money in the formal market to deploy it in affordable housing. You are not a trusted, person, or you're not yet known in the market. So it becomes quite difficult to get that kind of funding. And that's why, for instance, you have DFIs who believe in us, but their focus is actually not necessarily a return on investment. Usually their focus is other things, maybe green financing, maybe, the more uptake for housing in the, affordable or the social space, and things like that. But even then, you find that when I have set up as a private equity, there's a fiduciary responsibility to my investors and an expectation on a return on investment. So that being pitted against other traditional forms of investment is quite a challenge.
Fantastic, thanks. Ngacha, maybe just to you and on the topic, what do you define as an efficient capital structure for real estate? What are the hallmarks of this? Is it relevant to be looking and comparing ourselves with global peers?
Thank you, Wayne. I'll take Peter's cue and also shortly just introduce my firm, Spearhead Africa, and We're an investment advisory firm that works with institutional investors. These are the pension schemes and insurance companies, and primarily on their investments into alternative assets, which includes property, infrastructure, private equity, and the likes. When I think about the inefficient capital structure, it's really just the mix between debt and equity that maximizes the value of the asset and also at the same time minimizes the financial risk. And that optimal mix is really a factor of various things. Number one, it's the type of property or type of sector you're investing in, property sector. It's the market conditions. But an often overlooked component is the investor preferences or their risk tolerance. And I think that's where we need to really spend some time. So, put very simply, I believe an optimal capital structure is that which allows funds to actually flow into a project, right? You could have the smartest, cleverest structure from more developed markets that ticks every box except the one that's most important, which is investor preference, right? So, when I put my local hat on, I do believe that, yes, there is some things we can learn from the global market, but we have to remember that money everywhere follows the same basic principle, which is risk and return. And the risks and returns in global markets could be significantly different than they are here. So it's important to not assume that what works there would work here because the conditions are very different. And when it comes to the conditions locally, what we have found is that the local investment community really looks at maybe 3 or 4 key elements in a typical structure. The first is that complexity is the enemy. These are very conservative investors, and anything that is difficult to understand or even just out of the box slightly is more likely than not to receive some kind of pushback. The second is tradability, and this really is where the capital markets comes in. Giving investors a all or nothing choice will often lead to them saying then it's nothing. But allowing them to invest through capital market instruments gives them the opportunity to dip their toes and to gain exposure as they become more and more comfortable with the opportunities that they're looking at. The next thing is transparency. And this is why I have a lot of empathy for my colleagues in the private equity space. Because what you find that the local investors are very keen to understand exactly how these returns are made. And they want to understand what are the risks, what are shaping those risks, how can those risks be mitigated, and to convince them that what you're offering is not just a promise in a black box. Yeah, they have to be fully aware of not just the underlying asset itself, but also the larger macro factors that can affect those returns. So once you align those key elements, you find that I would believe that that's what makes an optimal structure. I mean, talking about whether a project should have good returns or whether the sponsor should have a good track record, I believe that goes without saying. Yeah.
No, that makes a lot of sense. And I guess ultimately it's about creating a blueprint for investment to follow. Investors globally are looking at Africa for success cases, platforms, and case studies. So yeah, I think that's exactly what we were saying earlier. Simon, with your focus being more in the MES space, I mean, I think this is really interesting because it's traditionally been something a bit more sort of private equity sourced. How are you seeing this change, and in particularly with regards to commercial banks' perspective, and what really MES, I think, is misunderstood holistically on the continent? So why don't you give us a little bit of 101, but also how you see it sort of changing?
Morning, Wayne. Morning, everyone. So I think it's quite interesting. So, we talk about the growth that's happening in East Africa, and with that comes a natural requirement for additional capital. People have been very reluctant with MES finance, and we've seen it in South Africa as well, because there's naturally a higher cost attached to it, which is a deterrent to a lot of people pursuing that level of funding. But with MES being a hybrid between equity and debt, it gives clients a lot more flexibility. There's a lot more in bespoke transactions that we can structure, which has helped to unlock a lot of those opportunities that clients could naturally not spread their own equity across. It's also, I think, from a strategic point of view, from a bank's perspective, Also important to follow our clients and mature with those clients as well by providing them with new products that better suit their requirements. So we've seen quite a bit of take-up in South Africa. We see the product being successful there, but we've also seen it being successful here as well, where clients have got a multitude of opportunities and a real value add as banks try to be their preferential partners with clients as they continue to grow as well.
Great. Godfrey, as the largest DFI globally, I mean, the role that IFC and other DFIs play in the continent is massive. But from a liquidity and impact on the capital markets within Africa, how do you see this having gotten to this point and going forward, the role that DFIs play in the overall commercial real estate sector?
Thank you, Wayne. I think just to maybe as an introduction, obviously IFC is the private sector arm of the World Bank. And our focus is really to work with the private sector, as distinct from, the World Bank per se. I think when you look at it, I mean, our shareholders are member countries globally. And basically each country has got needs. I think the government alone cannot drive an economy. So it's important for us to support the private sector, and hence why we were created. We believe that we play a big role there, not necessarily alone, because we also have, we are quite active in terms of mobilization. But we bring to the table, I think, beyond money. I think the question that one should always ask is, if I'm approaching IFC, what is it that I need? It's not just money. I think if it's just money, money is a commodity. I mean, what we bring to the table beyond money is obviously, I mean, there's long-term capital, which you don't necessarily find in these markets. There's best practice, there's knowledge. Peter was talking about edge here. So I think for us, it's about beyond money, what are we bringing to the table? And is that best practice something that can be adopted by the market? In an ideal world, maybe IFC would work itself out of business when, the private sector or private banks can fully address the market. But that's an ideal situation. So we collaborate as well with, the private sector in terms of commercial banks, private equity funds, but we do direct funding in those sectors that are underserved.
Okay, no, that's great. And Stephen, I'm very keen to get your thoughts on this topic. I mean, you really are sort of in the coalface of structuring these from a legal perspective, and it's not just about sort of looking at sort of how waterfalls flow on an Excel spreadsheet. It's very practical, and talk us through some of the regulation and policy around sort of more instruments. Are we seeing the right amounts of regulation in place? Is this a barrier? Or is it really the source of capital too narrow and not enough platform success to use the instruments that are actually available?
Thank you very much, Wayne. So first of all, so let me just briefly introduce so the firm that I'm a partner at. So I mean, we're a full-service law firm. We offer services across the spectrum. But I think one of the areas that we pride ourselves on is that we have done a couple of very interesting property-related transactions, especially in the REIT space. But I think I'll talk about that later. But what we have seen over time, I mean, and obviously, like you said, we are at the coal face. So we have seen over time, obviously, when property transactions were being structured, it was very simple. The developer shows up, he's got his equity, senior debt, bank lends in the money, and the deal is done. But increasingly, obviously, these deals are getting a lot more sophisticated. The capital structures are getting much more intricate. So mezzanine finance, DFI finance, and so they're getting more and more complicated to stitch together. Even the conversation around efficiency is not a conversation that traditionally developers have actually had, right? About how do we structure you know, this investment in a way that deploys the capital in the most effective manner. So for us, of course, we're in the middle of these conversations. I mean, we're listening, you know, the financiers across the table, the developers, and so on. And so and I think to Ngatia's point, there's a lot of hesitance in adopting new practices, in taking up new products, right? So we've developed, when I say we, Kenya, obviously there are regulations in place to allow for development of new products, REITs, mortgage-backed securities, across the table. I mean, the regulations are there. The appetite to get innovative in structuring these deals is actually, sadly, is very limited. And so you have a few brave souls, if you want to call them that, who have been prepared to stick their necks out. And I know Akon is in the room, one of the few developers who've actually decided to look for alternative ways of raising capital, apart from the traditional routes. So the uptake is slow, I think, but we're seeing a greater appetite for innovation in raising capital. Right?
No, that's great. Peter, the continent's acute need for affordable housing, I think, is often in contrast with some of the challenges around the sort of commercialization and funding of it. I mean, how have you managed to overcome this at a sort of Pan-African level, but certainly also in a Kenya context? And you've seen a lot of other crises come and go and bring its own sets of challenges with access to capital and efficient funding options. I mean, what is, particularly in an affordable housing case, how have you seen this play out?
Yeah, thanks. I think the best example we would give is, I think, our experience in South Africa, because when we started the IHS in South Africa, that was 2005. I think the first projects were being signed on in 2007. Affordable housing as well was not a big thing in South Africa as well. So it was something that, of course, there was a need. Just like in all African countries, there's always a need, but not many players were doing affordable housing. So we had to go into the market and redefine the market, redefine what sizes are actually acceptable. For instance, if you're in Kenya, a while back, apartments would be, between 130, 150 square meters. In South Africa, the same thing. We had to redefine what feels as spacious.
Yeah.
And because, if you want to build affordably, it means as well that, your cost of construction cannot be too high. So that we had to redefine what affordable meant. We reduced sizes, but still kept the feeling of spaciousness. Our units are, 52 to 60 square meters, both in South Africa and Kenya. And most people who walk through when we host conferences in SA, and a lot of Kenyans come and they walk through our units, they say they feel quite spacious. But now we took it further than that as well, because once we were able to manage our own properties and, define affordable housing as a defensive asset class, then it was much easier now to raise capital even in the formal market. In South Africa, for instance, we registered a REIT, and during COVID, for instance, we were the only REIT that was, getting like 95 to 98% collection, almost 99% occupancy at that time, compared to like the commercial REITs, which were doing 40% through COVID. And Wayne, I think you're aware of how that was. So we were able to prove, even during COVID, that affordable housing is a defensive asset class. And then, so there was much more confidence in, coming to, to IHS, and, more investors had their confidence in us, in the instruments that we have. And that's why we've been able to, fundraise not only just in South Africa, in Namibia, Botswana, and now in Kenya. Thank you.
Yeah. Great. I think quite closely tied to impact is obviously sustainability. And Godfrey, I mean, this is really now a key driver of liquidity globally. I mean, last year we saw about $1.5 trillion worth of sustainable debt issuance, and regulators delivered probably the most guidance and the policy that we've seen on record around the sector. I mean, with Africa contributing, 2 to 3% of carbon emissions, I mean, how is this shaping capital flow when we are not necessarily the contributors of how we got here, but certainly will be the biggest impact of climate change is going to be on our continent?
Yeah, I think climate change is quite real, and the realities are that, I mean, obviously, Africa still has a long way to go to get to a stage where it can be labeled developed. I mean, what does it mean, you know, under the current climate? Because we can't go on with the traditional way or means of funding, which results in, you know, huge GHG emissions. And I think, you know, IFC has been at this game for quite a while now. I mean, over 10 years ago, we came up with the EDGE, you know, tool, which is excellence in design for greater efficiencies, which really has been a great success in terms of being mainstreamed. And we have not, you know, tried to tree hug this and say, you know, this is our product, we are not going to mainstream it. Even, you know, investments where we are not, you know, we haven't put in money, we do certify those kind of, you know, buildings, because we want to contribute to the climate agenda. So I think at the end of the day, I think the reality is that, you know, there has to be an approach that addresses this. And I think in terms of new projects, I think it's become a norm for us that, you know, any project that we're doing should typically be EDGE compliant, because, I mean, it's beneficial to the client, it's beneficial to the investor, it's beneficial to everyone, because you're actually, you know, reducing GHG emissions, but also, you know, optimizing on operational costs down the line. I mean, the elephant in the room is, what do we do about the existing buildings? Because, you know, buildings emit, I mean, almost 40% GHG emissions, and that's a big contribution. And, you know, there's this aspect that the, you know, ABSA CEO mentioned around urbanization and the need for more real estate, basically. So, I mean, the reality, I mean, what we've, I mean, the innovation that we brought around that is a product called GRIP, which is greening of real estate investment portfolios. So, I mean, looking at existing buildings, which, you know, are all over, there is, you know, an advisory and investment program that IFC provides, where we would work with the client to diagnose and kind of come up with an understanding of what the need is in terms of greening those existing buildings, in terms of retrofits. And then we come up with a CapEx program in which we can actually support and finance to ensure that, you know, we contribute to this agenda. And then, you know, we're seeing a lot of, you know, investments in terms of green bonds. You know, we're talking to banks in terms of, you know, because, I mean, for us, we don't only support developers, but we also work through banks. We have partnerships with banks. And we're looking at green facilities or green financing with them. So I think the future is climate financing, and we're doing our part in that. And in addition, I think the World Bank, of which is, I mean, is part of the World Bank Group, is also doing quite a lot. I mean, for example, I think in this market, we have an advisory program that we're supporting through what we call the Joint Capital Markets, or JCAP, where we're supporting KPDA, you know, the stock exchange, around, you know, a toolkit for REITs. And I mean, that's one of the avenues in which we can, you know, provide funding to the market. So I think we believe, you know, we are there, we will always support this, and we're very optimistic about the future.
Fantastic. Ngacha, I want to get your take on the extent of debt capital markets. Are we seeing improved access to funding for real estate, and is particularly the sort of love affair with Euro bonds kind of waning, and will we see more, I guess, issuances of corporate type bonds, whether it's green bonds or sort of more traditional corporate bonds?
That's an interesting question. Is the love affair with Euro bonds over? Well, if that love affair was premised on or was built upon basically the low interest rates in the developed markets and higher interest rates in more emerging markets, including our own, then we had the panel that was here right before us. I think it is. Yeah, interest rates are being hiked aggressively, and what that means is that the returns here now are relatively less attractive, where at the same time the risks are the same, or in many cases are elevated with concerns around government debt sustainability. But that being said, and I don't want to go down an economics tangent, the capital markets remain a very important source of funding for property investments globally. And that's true also in Kenya, although here what we found is that they're relatively untapped. But they do work hand in hand with traditional banking funding, for example. But one thing to remember with the capital markets is that the investors in these capital markets are very rational. They're rational actors. They will compare the opportunities they're looking at against others. And it goes back to that risk-return equation that I mentioned. And so I do believe that debt capital markets are definitely the way to go. In fact, if you compare debt capital markets compared to equity capital markets, I think the debt capital market side have some distinct advantages. Yeah, in terms of where does investor money sit in the capital structure, it's relatively more secure. In many cases, it's actually secured completely. So if you're a conservative investor, that's where you start. And then as you start becoming more risk tolerant, you start to look more into the equity and the likes. And so I think for good issuers that have solid projects, the capital markets are open, and I know from engagements with the regulators and with stakeholders like the Nairobi Securities Exchange that they are always looking for new issuers to come to the market. And whether that's through equity-type instruments like REITs, or whether that's through bonds, whether it's green or otherwise, that I know IFC have been pushing, there's been a big opportunity for local developers to tap this market. Thank you.
Great. Peter, I want to come back to you and just follow on from what Godfrey was saying around sort of the impact of climate change, and I think impact in general as a concept. Africa has a lot of unique sort of attributes and impact to offer investors looking to make that. I mean, how do we use this and sort of lean into it to create more liquidity and really raise the profile for global capital to come in to Africa and make an impact and have a good commercial return in the process, right?
Yeah, I think I'll answer this question let me break it down in two. First of all, there's the upstream side where you have a lot of, organizations that are pegging investments, to green investments right now. There's a lot of allocation of funding from, people like the Earth Fund, GCF, and for us, for instance, when we were raising capital from players like the UK CEI, the European Investment Bank, and even IFC, a lot of this investment is pegged on how green the fund is. And of course, this directly goes to impact. So I find that there's quite a bit of access of green funds right now. What I find that is, even though the green funds are there, there's still also an expectation of return of investment. So it's not just a blanket amount of money that you're going to get. On the retail side, or the downstream side, there's actually impact that vests to the people who are going to use these funds. For instance, in our case, every person who lives in an IFC EDGE certified house, there's actually a gain. Number one, you actually gain in terms of savings, whether it's in electricity or in the water usage, and we've worked this out that it translates into at least a month in rent for every year you live in an IFC EDGE certified house, or a month in a mortgage payment. Every year you live in an IFC Edge certified house. This is a direct impact to the person living there, and of course, when this is marketed, then it makes people much more aware that when they live in a house that has been IFC Edge certified, there is actually money that can invest into their pockets. But other than that as well, we would like more players. Like, let's say, for instance, if ABSA in South Africa give a bit of a discount for green housing, for mortgages. No, it's true. So we would want if that, for instance, would come to Kenya. And I'm looking at ABSA guys and the ABSA CEO for Kenya. I don't know where John Kaburu is, because I think this is a conversation we should have with him, where for every green house, this should translate into, even if it's a few basis points off on mortgage, it would actually be a big push for mortgage uptake in Kenya. Yeah, thank you.
Great. Well, might as well go to Simon and get your views, I guess. Beyond MES, the evolution of commercial banking products for Africa, are you seeing change? And importantly, a lot of institutional capital, real estate capital out of South Africa has gone into Eastern Europe and other jurisdictions and almost bypassed Africa. Now, I think actually what we're hearing is quite a positive story about evolution and maturity around sort of instruments and products and regulation. Do you think this is sort of the time to, now that the rest of the world is going through its own challenges, to be attracting more of that capital from South Africa, but also other institutional capital on the continent? We see hugely disparate sort of investment volumes of pension fund into real estate by different countries. Some are completely over-allocated, some are completely under-allocated. The net impact is definitely under-allocated, but want to get your view from a commercial bank perspective.
Well, it's quite interesting. So in my mind, much of the, South Africa is still seen as an emerging market itself. So in my mind, a lot of that is bypassing Africa as they chase a more stable growth outside of the continent. I see more the flow of, or inflow of capital into Kenya and the likes of East Africa to come from your developed markets, chasing a higher return from a market that is currently now developed or developing in terms of its maturity. You just need to drive down the roads here and see the amazing buildings that are coming up. There's a strong focus on government towards affordable housing. With that and the ESG kind of initiatives and goals that some of these DFIs have is a great incentive to attract some of that funding. Yeah. So I definitely think that, from a global perspective, there's definitely developed markets where we can attract that funding into the likes of East Africa through the focus both from a government and from an ESG perspective. And that's something that I think that the East African continents haven't necessarily seen, given this renewed focus on ESG.
Yeah. Great. And I think final question for you, Stephen. I think there's what I've sort of noticed a lot of policy changes bringing a bit more of an homogeneous approach to sort of the broader region. I mean, how important is this for investors looking at more of a pan-African play? And many of them are in the room here today. Some are only focused on Kenya and really understand those policies, etc. But, in terms of uniformity, whether it's tax or sort of broader, investment policy, I mean, how important is that? And are you seeing the progress that's needed?
A couple of years back, obviously, there was quite a lot of impetus in terms of trying to create some regulatory convergence within East Africa. And the East African community was really active in trying to harmonize whether it was the capital markets laws, and so on and so forth. In the recent past, I think that sort of policy convergence, regulatory convergence, that conversation seems to have slowed down a bit. Obviously, it would be ideal because then it means that investors can look at the region in terms of a bigger market. But just, I mean, while we're on policy, let me just speak to the issue of some of the challenges. And I know this is not a forum where we want to start, complaining that this doesn't work and that doesn't work, because obviously the challenges with titling, the challenges with even with the capital markets regulations that we have. So for example, when we did help to structure 2 REITs, we realized that a lot of these regulations are cut and paste. I mean, we go and borrow them from other markets. So you go to South Africa, you pick something from there. You go to the UK, you pick up something from there. The problem is when you start trying to do a live transaction, you start coming across all sorts of bottlenecks, things that don't quite work, don't fit for this environment. They're things which are unnecessary. They're corporate structures that are not familiar to us, whether in the regulations. So we ended up coming up with like 20 pages of recommendations to the regulator about things that you need to change to make it easier to originate, to get a REIT to market, right? Now, obviously, we looked at the finance bill. None of the proposals that we made were in there, right? But I think the policy conversation is really important. Yeah. The property developers, the investors, have to have a really robust engagement with the policymakers so that our regulations make these transactions as easy as possible.
Great.
Yeah.
Well, we are out of time, and I'm conscious we haven't necessarily had any questions, but I think as a topic we've sort of barely scratched the surface in many ways, but it is a topic that will permeate pretty much every other conversation and panel that happens over the next 2 days. So a lot of really good opportunities to kind of unpack the topics further and understand how it impacts very specific asset class situations, geographies. But I think on the whole, it's been sort of quite a positive review, and certainly in terms of evolution, I think a lot of it is, the world has gone through such a difficult and tumultuous period, but as Africa, we're pretty battle-hardened, right? I mean, we've been there, we've seen commodity, cycles, we've dealt with all of it. So I think as a region, we're really realizing that toolbox needs to evolve, and it definitely is. And I think credit to a lot of people in this room and really sort of creating those success platforms for more capital to flow into the sector. So thank you very much to my panel. Everyone else, by all means, grab them for a question afterwards and enjoy the rest of the conference.
Thank you. Thank you, Wayne. Thank you, panelists.